So you can ask me question for what I've said, what is not too clear.
Yes, we would love to start taking your questions. We have about 10 to 15 minutes to do that. So please,
Welcome.
you can just unmute your mic and ask your question, or you can text it in the chat section. Okay, let me ask one question before. Maybe you're trying to put your questions together. You said ratio 2 to 1, and let's say for instance, a business after paying like their debt, and after paying like maybe their customer, their internal customer, that is like their staffs, then they now noticed that what they add in their account is not like a whole company should have, something like about 30K or 20K left after paying salary and paying their payables. Would you say they've maybe probably they didn't manage their cash flow well, or that did not fall into the principle of ratio 2 to 1, or what could have been the problem, and how will they solve that as a whole company? After they've paid their salary and paid their payables, they are not able to, or they are now relying on the sales that to come in for the next month for them to continue funding the business.
I mean, that ratio 2 to 1 is always advisable, but out of that ratio 2 to 1, you have met from what you have explained. They pay salary, they paid uh, their suppliers and everything. They are knowing anybody at that moment. The,
Adam,
that 30K is relative. It's relative in the sense that, okay, if there's an opportunity, maybe for a business opportunity that could earn them maybe a gain of like 50,000, but they have to invest about 70,000 in that business to be able to earn that 50,000. It means that the 30,000 they have at hand will not be sufficient to take care of that opportunity. That's okay. You also have to build a reserve, because there are times some opportunity will just come suddenly. If you have cash on it, those who have cash will take advantage of it. Those who don't have cash will say, well, so that you still have cash at hand is a good thing. I mean, you are not clean out, as it were. And that is why some
mhm,
organization, especially if you have run business for a while, they have what we call this revolving overdraft. Revolving overdraft enable you to create advantage. Like for instance, the example I give, they needed 70,000 to take advantage of this new opportunity, and they have only 30,000. They just approach their bank and withdraw the remaining 40,000. And because at the end of the day, the interest they will pay on that 40,000, compared with the 50,000 they will gain, they will still be able to have some money. Though if they have that 70,000 as part of their reserve, without going to the bank for overdraft, that gain of 50,000 will come to them completely. But now, because they have taken overdraft facility, that 59,000 will be shared between the interest on the overdraft and the company. So let's say the interest on overdraft is about 10,000 now. So instead of making a gain of 50,000, they will now make 40,000. So this is how this thing works.
mhm. From Mr. Musa, in practice, how do we model seasonality and forecast out cash flow? How do we automate and monitor our receivable and ensure prompt collection?
Okay. Well, these are questions that could be addressed, especially if you are in a big business, a big company where you have accounting software. Most accounting software will do this for you. And when even in your budgeting, yes, you can model your budget in such a way that, okay, um, what you say, because budget you have to, at the end of the day, you have to break your budget down into months. Before you have the aggregate. In January, this is how much you can sell. This is if you give credit facility of say 6 weeks. So, or you say, okay, when the customer is buying, he's paying 20% down, then in 6 weeks you pay the balance, or in 2 weeks. I mean, depending on the credit something, there are ways you can do this even in simple Excel if you know how to use Excel. It's a lot of work, but by the time you design it, use all those formula, it becomes a lot easier to manage after that. It's the initial setup that is a bit tedious, but most accounting software will do that for you. And anybody who knows how to use Excel very well can also do this. So it's not something that is too complicated to do. So it shows you that though I'm selling 50,000 this week, this month, I'm collecting only 10,000 from this month. The remaining times 40,000 I will collect over a period of 3 months. So there's a way you can you plot that figure. Out of the 30,000 I sold last week, I'm collecting 20,000 there today, this month. So your cash inflow will be the 10,000 of the current sale plus the 20,000 from the previous sales, and on and like that. It's something that is your accounting software can do for you, or if you know how to um, design your Excel worksheet, it can do it for you. Yeah, there are software that can do all this one. It's not too complicated. Then there's another question: is cash flow the same with net profit? No, they are not the same. The net profit is about your sales minus cost of sale, which then you get your gross profit. Then other administrative and other expenses, marketing, you eliminate that, including tax. Then you have your net profit. This is the amount like, okay, I sold goods of 30,000. I pay supplier this, I pay salaries, I pay government. Then I have a profit of 5,000. Like the example I use, which I repeated again today, my net profit is 20,000. But my customers are owing me 25,000, and I'm owing a supplier 7,000. So my cash flow is negative because though I make 20,000 profit, 25,000 is outside. I have not earned that money. So I have a negative 5,000. But again, because I'm also owing somebody 2,000 to 7,000 that I've not paid. So my cash flow at that moment, I may have actually I will have something like a range of 2,000 with me. Now they are owing me 25,000. My profit is 20,000. I already have a cash shortfall of 5,000 because of that. Then I'm owing somebody. Because I'm owing somebody, I've not paid. I'm supposed to pay somebody 7,000. So if you take that 7,000 from 25,000, there is a net of 18,000. If you net it off, meaning what the cash I have at my hand at that moment is only 2,000 out of that 20,000 profit. My 20,000 profit plus the 5,000 I'm owing the other person is in the hand of the person owing me. So that is where I am not in a very comfortable state, despite the fact that I made a profit of 20,000. So what are the major cash flow KPI? Ability to meet your obligation as and when due. Because like I said in the first episode, if you don't pay your creditors, they can sue you. They can apply to court to wind up your to wind down your company. So there's a risk there. They can stop giving you credit facility. And if you don't have cash at hand, it means if you are in production, you will no longer be able to produce. Or if you are doing supply, you won't have good in store. Your customer will come, but you don't have stock to sell to them because you don't have cash to go and replenish your stock or to buy on credit. I mean, you can't buy on credit, you have to go and buy cash. And if for you to buy on cash, you must have cash. Then when you don't have cash in your hand, you are done for. Ability to take advantage of business opportunity, you will lose that one out. So these are the KPI about cash flow.
So thank you so much, everyone. We hope to see you in our next episode. Bye. Thank you,
Okay,
everyone.
thank you for everybody. Thank you for joining. So it's always a pleasure having you.